Alrighty. Let's hide this actually. Let's get this up in here. Oh. Howdy. This is playbook video number 3, if we don't include our intraday playbook. This is a quarter over quarter strategy, maybe even 6 month strategy. So it's a long strategy. It's not long in the sense that you are long in terms of delta, but long in terms of it'll take a while to execute. And this strategy is known as scalping gamma. Ever since Black-Scholes came out with their, Black-Scholes was another guy too, that came out with their model, market makers have been a lot better at pricing in options. And simultaneously, we've kind of had these rough equations for how to calculate how an option should be priced. Discrepancies that move away from the Black-Scholes model can often be interpreted as signs of the market pricing in bigger moves. But what's more that's come out of Black-Scholes is we now have the option Greeks. Now, the first and foremost, of course, being delta, how much the option price will move based on movements in the underlying. The other being theta, how much premium or the price of the option will decrease over the passage of time. Then we also have other ones, which are vega and gamma. And these move us, if an option is the first derivative, these move us to maybe the second and almost the third derivatives of this option price, which is really interesting. And now, previously it used to be before Black-Scholes, you'd buy options and shares and you'd be adjusting your delta and you'd be doing it in such a way where you'd be able to find opportunistic moments. Excuse me, I'll turn that off. You sort of find these opportunistic moments into which you could bring in, I'll add to my position here. But now we sort of have to play in these second and third derivatives as the market's really good at pricing the first derivative. But it's not always great at gamma, and you can use shares to sort of manipulate gamma in your favor. So we'll get into what gamma is a little bit later. I might not even put it in this video. There's a lot of research on option Greeks already. I just want to get into what the trade is. So how do we run this strategy? Remember, first and foremost, it has to fit into the Birds of Paradise rulebook, which means it has to be delta neutral and it has to stay delta neutral. This works really well with calendars. It doesn't work so well with things like straddles and strangles, and we're actually going to open a long-term strangle for this position. We also have to remember that we need a high probability that we'll be profitable. There's no reason with options that we hold over time for us to be taking on a position that only has a 30% chance of being profitable. Why would we run that? Right, of being profitable, not even a 30% chance of tripling our money, right? There's no reason to run some of these positions. So even if we have to sacrifice some of the risk reward by running this strategy, it's important that we do so, and we'll jump into it now. So you're going to hold a long option position that is delta neutral over the course of at least a quarter. What we do here in our first yellow time slice is where we open a straddle that expires at the end of March, our second yellow time slice here, at the closing price of December 7th. And we pay about $21 in premium so that we can open this straddle, and we're going to say we open it right at 105 just to be easy. Now that we have this straddle open, we know that over time, if it chops around this 105 spot, we're going to lose money. And we need this option, or not this option, but the underlying. By the time March 15th rolls around, we need it to move either up 20 bucks to 125, or it needs to move down 20 bucks to 85. And we've been lucky enough, of course, we're going to use an idealistic case to showcase how this strategy works. This is a case where we'll actually be able to return something like 50%, whereas someone who's just holding the straddle would only be able to get out for even in a few months. So let's jump into it a little bit further. December 7th, we open our 105 straddle for $21 in premium. And moving forward, we are actually going to adjust our position in terms of shares as a way for us to stay delta neutral. So traditionally, if I had a straddle and I opened it right here, we go up, and then when we came down, I would be negative delta here. In order for me to continue to make money, I would need it to continue to drop. If it then proceeded to go up, I would start losing money, and I'd fall back into a trough where, a month has now gone by and nothing has happened except for we're still trading at 105 and a bunch of premium has fallen off my straddle. If I am just holding an option here, I am getting wrecked. I'm not playing my position properly and I'm just bleeding premium. There's no reason for me to have opened the straddle back here because a month later I'd be able to get it at 30-40% off. at the same price. So what are you doing? So what we're going to do is we're going to, again, trade shares. And you can probably already see it on the chart. When we come down from 105 and we hit 100, and again, this is an idealistic case, we are going to long 50 shares. With our straddle and the beauty of options, it's almost as if we've simultaneously gone long and short 100 shares in both directions. And in order to take advantage of this positioning, we're actually going to buy shares in the underlying. So now we fall down and we get to 100 and we long 50 shares. And within a few days, miraculously, it bounces back up to where our straddle would be at max pain. And instead, we're now long 150 shares from down here and short 100 shares from up here. So we come up and we're going to close those 50 shares at 100. And sure enough, it threatens to the upside. It comes back down to 100. We buy 50 more. It goes up. We sell them. It goes up to 110. We go short 50 shares. It goes down to 105. We buy them back. Nothing really happens. It comes down to 100 again. We say, well, this has been good bouncing up until now. We're going to buy in more shares. It comes up. We sell at 100 again or 105 again. After going from 100, we've done 1, 2, 3, 4 scalps. Actually, I'll draw them here. We'll go 1. We did another scalp. We did another scalp. We did another scalp. With shares, we don't have to worry about the passage of time. We just get in when we think it's opportune, and we get out when we want. And each one of these represents, if we move 50 shares, $250 in profit. After commissions, we'll say it's $200 in profit, and sure enough, that's $200, $400, $600, $800 before our earnings report. Now, we're not going to hold anything through earnings, and if you know there's a major catalyst, stay the delta neutral. Stay theta negative. It sucks. It sucks to hold it. But you don't really want the skewed position that you get once you come down. You'll take on a skewed position. And we'll get into the Black-Scholes model when we look at potential future trades as opposed to analyzing the historic trades. So here's a pretty ideal case where we enter the straddle, and for the first 2 months, all we are doing is just scalping the shares for money up and down, which is groovy because now we've paid $800 out of the $2,100 in total premium back into our pocket. And if we're trading right here before earnings, our straddle's probably lost about 50% of its value. And after earnings, if there isn't a big move, it's going to lose probably about 80%, maybe 70, 80% of its value. These are rough ballpark numbers, but I've traded enough options to feel good about those predictions nowadays. So we take 800 that back off the table as opposed to being sitting here and going, oh, wow, before earnings, I'm actually out like $1,200 on this position. So now I'm desperate in terms of I need a move. But instead, because of all our scalping, we're actually just down $400, which for us, it's like, well, okay, I held for 2 months and now I'm only down $400 on a $2,000 position and I got a month and a half left on it. I love that. From there, of course, we come down. Maybe we're silly and we're like, oh my God, okay, we try for a couple scalps and we end up long 50 shares. But if it keeps dropping, that's okay. That's a good problem to have. Because ultimately, these calls will go to worthless, and that's fine. But we're still short shares because we have our straddle puts. And eventually, this will come down and hit 85. Excuse me, oh my word. And sure enough, that 85 is the $20 to $21 we needed in movement from our entry so that our puts actually have enough intrinsic value to cover the entirety of the premium. And so now we can sell those puts for $20, $2,000, I guess. And from there, we're lucky, of course, that this happened. But we also collected the $800 in premium. So now we have $2,000, our total premium taken off the table, plus the $800 we've decided to scalp. So we're up probably about 50%. And maybe we're smart enough, we buy at 90, we sell at 95, and we make a couple scalps on the way down because, we're allowed to do that. Our positioning allows us to play the position. And for us, we think, okay, cool. Well, you've made a big breakout past the value area, so you'll probably continue to sell, but we're going to buy in hopes that we can get out. So there's other scalps we can make intraday. But the idea is you scalp at these even increments as they come back to your target price. And our target price, of course, is 105. Our target price to take profit on our straddle is whenever each or one of the legs can pay for the entirety of the straddle. That's our plan. Okay. So there you go. We now close this trade out once it hits 85 and we think to ourselves, hey, big round of applause. It took a quarter, but on $2,000, we were able to produce $800 in gains. This is more my speed. Scalping gamma exists, right? This is a strategy that's existed before. So it's not, new by any means. Maybe it's been around for a few years now, probably since about 2010. And maybe even earlier in the good options traders. So we have to add our own spin to make sure that we're trading our strategy as opposed to something else. And I have two signals up that we're going to use to trade our strategy. One is our volume profile, and the second is implied volatility. Now, before we get into our entry signals, let's go over a potential entry we see building up just actually right now in the day over day in Caterpillar. These guys need a China deal because they do a lot of work in China. So that's one big macroeconomic thing to consider, but we won't get into that quite now. Macroeconomics are interesting to think about because we will be holding for a number of months. We kind of want to be able to have, oh, I believe the run will continue, but we'll chop around before it continues to run to 155, or oh no, this will be a big turning point. It'll touch 150, we'll short, and then it'll plummet to 120. Regardless, we're going to buy these Aprils. We should probably buy the Mays, but we're just going to talk about the Aprils for now. And there's two things we want. We want it to trade in and around our volume profile's point of control. We like these nice sort of bell curve standard deviations of where traders get in and out so that we know, hey, the market thinks 140 is a really fair price for this stock. If they were trading, 3 quarters ago, they would think 140 is fair. If they were trading, last year, they'd probably think 150 to 155 is fair. 55 right up here. If they were trading just this last quarter, they'd probably think around 125, 130 is a fair price. So we know that 140, based on the last year of trading, is kind of where this stock likes to be. Not only that, we know that we have to pay a hefty premium to open our straddle. So in order to make sure that our premium is low, we're also going to enter a time where implied volatility is low. We don't necessarily need the realized volatility to overpass the implied volatility when we open the position, right? We are taking a position where, I believe we are Vega positive. We want an increase in implied volatility so that our options go up. But regardless, we don't need realized volatility to come through because we can do these intra sort of week over week scalps where we make a little bit of money with shares to take the premium off and the cost of this implied volatility in the form of that theta or that premium that we open. Wow, that was a big word salad of words. So what do we do? Well, we see, hey, implied volatility has fallen a lot over this sort of pseudo rally where we've seen us slowly climb. Groovy tunes. The next thing we've seen is that it's actually approaching where it likes to bottom over previous, quarters. It doesn't really like to go below 20. So at 26, we know that we're getting a fairly cheap price for our straddle. As opposed to us buying the straddle, right here at the peak, we'd probably pay a lot for it, even if, of course, we're buying the exact bottom and the call side would just go on to make money. The put side would still be expensive down here. So we like that in implied volatility. All right, we've prepared this because it's a playbook video, so we want to be able to get through this quickly. On our analysis tab here with the Black-Scholes model, we will be evaluating CAT. So the plays we've taken on is just sort of something that has 45 trading days left. We'd probably take on something bigger, but we are, if I can move this up here, going to take on, maybe a little bit further down, a 140 straddle, and we're going to assume we get, $2.10 in, or, $2.50 in movement to push us up to 140, and then we open it flat. That is the ideal entry, is that you open it right when you can open that straddle, right? And we picked 140 because it's pretty much exactly on that point of control. So we opened that for $5.10 a piece. We looked at this and it's like, okay, well, that's approaching $10. So a conservative estimate here would say a little bit over 10, looking at these two spreads. So, 10.20 seems pretty good. And here's the straddle alone. Whoopsies. You can do it, little computer. You can do it. Of course, 140 is a big plain point, and we're putting on about $1,000 in premium. Ouch. If over, this is one at expiration, but we're also going to sort of do day steps. This is sort of week over week. In 4 weeks, this would be sitting at $300, maybe even $500 in the losses if we're trading right back at 140. And we're going to go through the process of performing these scalps. You see them on this sort of the 3 stock trades I have here not being analyzed, as to how this model of profit loss over time by strike will adjust when we make these trades. And remember, there's no Greeks attached to stock. There's no Greeks attached to shares. We can buy them and sell them willy-nilly, and we don't have to worry about time decay. So that is a groovy tune. That's great. We like that. So we're assuming we open at 140, and within the first week, so we're looking at this cyan line here. It's a little difficult to see. I understand. Let's get this out of the way. So we can have this a little bit bigger. We decide, all right, so we're trading at 145. If a week went by and we made it up to 145, we'd be kind of at break even. So if we put our little marker there, this 145 price would have a positive delta. If we're back at 140, our delta is basically flat. And if we're trading at this 130, 150 extreme, which lines up to sort of 150, 130, the extremes of this little bell curve we're trading and scalping around, we know that just our straddle alone would be, kind of break even or making just a little bit of money. It'd be making like 20%. Well, I think we can make that 20% in pure cash on our own, just by scalping these shares. So we begin by selling at 145. All of a sudden, if we're trading at 145, even a few weeks from now, the lowest our trough is going to get is like $200. Without the shares, we hit 200. We had $300 down here at 140. But not only that, if we're trading at 145, you see, 145 is up here now. This is a positive delta. We need it to continue to go up for us to keep making money. Otherwise, over the next week, we're going to fall down into this sort of pinkish red salmony color trough, which is going to print us 200 to 20% in loss. And that's threatening a stop loss at that point. So let's say we go up to 145, and that's when we take our first short of 30 shares. We say 30 shares, we're going to short. All of a sudden, these troughs are low. If we went back to 140, we'd be at break even, maybe out $45, as opposed to being out, 200, which is groovy. And not only that, we could then sell these for 140, and we'll do that just real quick, or buy them back for 140, and all of a sudden our trough now is only $44 deep. We've taken a whole bunch of money off the table because we've accurately scalped a few shares. Now what happens if we go short and it just keeps going up? Well, maybe at 150 we take on another short, and maybe we don't, but we're still protected to this upside to preserve our gains. And remember, our thesis is that we bounce around in this value area as the market does some consolidation. That truly is our thesis. Implied volatility is low. The market's not pricing in some big moves, but we are going to pay for that volatility, that premium, so that we can take on these scalps without having to take on a big delta position. That's the beauty of what options are going to do for us in this position. So we go on, we now move up to 150 and we short even more shares. Right? Well, at 150 now, we're at a pretty much an even delta again. And to the upside, we are going to make a little bit of profit. So if it takes off and goes to 160, we make 20%. And then if it falls all the way back to 140, well, two things can happen. One, the position overall will be up $150 if we don't touch any of it, which is groovy tunes. But we could then, back at 140, buy them all back for 140. And that would put us at a position where we're up 163 and we're holding our straddles. And that's over 4 weeks. The first week gets us to 145. The second week gets us to 150. We go short at 145. We go short at 150. And then over the next 2 weeks, it falls all the way down to 140, at which we clear our position for good profit and end up or flat at what would have otherwise been the max pain of our straddle. So without these these two shorts in the cover, we would be out 30% or maybe even 40% of our position. We're going to preserve those losses by making these trades. And so that's a cool little strategy that we can put forward. Scalping gamma, you can see how it preserves the Black-Scholes model the way we like it, the way the birds of paradise kind of wants it. Because if we look again, right, without this, if we're trading at 150, what's the probability that we're profitable? It's super probable. It's like yeah, keeps running up, you're just going to run towards profit. If it keeps falling down, you're just going to be able to close your shorts for profit. So now we have a position where, yeah, if we lose money, we're going to lose like $100 on 1,000. Sucks to have a losing trade, but we really maybe it's 200 after commissions. Big whoop, right? Whoopsies, Well, and then that's far better than where we would otherwise be. So we reduce the risk-reward ratio, or sort of increase it, whereas it's kind of 1-to-1. We're not risking a lot and we stand to make a little, but this is playing our position over time. And this allows us at the start of the week to look where CAT's trading and say, hey, at any point this week, if we blow past 145, look to go short. And we'll probably make these moves near the end of the day, try and capture the most movement we can. And again, it's about preserving our position and putting us in a position where we can make money regardless of where it moves, even after it's moved from our original open. So gotta love scalping gamma. Definitely something that I think a lot of traders who are new to options should look into. And yeah, I plan to do it in the coming quarters on paper and then transition this into real money. So that's the scalping gamma play. Here's an entry for us. If this hits 140, we're going to take it on paper, and we'll look to make this scalp all the way up until earnings. Maybe a better play would be to buy the maze, just so we can take in whatever volatility shows up here while the implied volatility is still low. Cool. One more time, if you want to look at how the trade actually comes executed, there's the take two play. Of course, we enter in and around the start of this peak at 105 and we scalp it. And this is, of course, a play where we get to scalp it multiple times before we ultimately get out. So, cool. Scalping gamma. Great play. Great strategy. There's your playbook number 3.